Global markets are reeling. A wave of selling has swept across major indices, leaving investors grappling with losses and uncertainty. In the United States, the S&P 500 plunged 1.97%, marking its second worst day of 2025. The Dow Jones Industrial Average followed suit, shedding 1.69%. The tech-heavy Nasdaq Composite suffered the most significant blow, plummeting 2.70% in its fourth worst trading day this year. This downturn isn't confined to US borders. Across the Pacific, the ASX 200 opened sharply lower, tumbling 1.3% to 7,881 points. By mid-afternoon, the index had extended its losses, sinking to 7,852, a decline of 1.6%. This global sell-off reflects a broader shift in investor sentiment, as worries about trade tensions, rising inflation, and slowing economic growth weigh on markets worldwide. The ASX 200's decline mirrors the weakness seen in other major Asian markets. Japan's Nikkei 225 index plunged 1.80%, while Hong Kong's Hang Seng index shed 0.65%. European markets also joined the global rout, with Germany's DAX index falling 0.96%. This synchronized decline highlights the interconnected nature of global markets and the shared anxieties that are driving investors towards safer assets. The recent market slump serves as a stark reminder of the volatility that can grip financial markets. While the long-term trajectory of the market remains positive, short-term fluctuations can be unsettling for investors. Understanding the factors driving this downturn is crucial for navigating the current market environment and making informed investment decisions. The current market downturn is being fueled by a potent cocktail of anxieties, pushing investors into risk-off mode. Trade tensions, particularly the looming threat of reciprocal tariffs by the Trump administration, have cast a long shadow over global markets. These tariffs, set to take effect on April 2nd, target a wide range of goods and threaten to escalate trade disputes with key trading partners. Adding to the unease are rising inflation expectations. The US February core PCE, a key measure of inflation, rose 0.4% month-on-month, exceeding the 0.3% forecast. This uptick in inflation has stoked fears that the Federal Reserve may need to raise interest rates more aggressively to combat rising prices, potentially dampening economic growth. Corporate earnings have also added to the market's woes. Lululemon, the athletic apparel giant, downgraded its 2025 guidance, sending its shares tumbling over 14%. This disappointing outlook, coupled with similar warnings from other companies like KB Home, has raised concerns about the health of the consumer and the overall economy. These factors have combined to create a perfect storm for markets, eroding investor confidence and fueling a flight to safety. As uncertainty mounts, investors are seeking refuge in more defensive assets, such as government bonds and utilities, which are perceived as less vulnerable to economic downturns. Amidst the market turmoil, defensive sectors like utilities and real estate are proving to be relative safe havens. Utilities, known for their stable earnings and essential services, have held up relatively well, with the sector gaining 0.76% in the US real estate, while down slightly, has also outperformed the broader market, falling only 0.01%. This outperformance underscores the flight to safety that is characterizing the current market environment. Investors, spooked by uncertainty and potential economic headwinds, are gravitating towards sectors that are less sensitive to economic cycles and offer a degree of stability. Utilities, with their regulated businesses and steady dividend payments, provide a sense of security in turbulent times. Real estate, while susceptible to interest rate movements, is also viewed as a relatively stable asset class. People need places to live and work regardless of the economic climate, providing a degree of insulation from market swings. Moreover, real estate investment trusts, or REITs, which allow investors to access this sector through the stock market, often offer attractive dividend yields, further enhancing their appeal during periods of market stress. Section 4. Geopolitical headwinds and economic uncertainty. Geopolitical events are adding to the market's woes. injecting a dose of uncertainty into an already fragile environment. President Trump's upcoming reciprocal tariffs, slated to take effect on April 2nd, have rattled global markets and raised the specter of a trade war. These tariffs, targeting a broad range of goods, threaten to disrupt global supply chains, increase costs for businesses and consumers, and dampen economic growth. Adding to the geopolitical tensions is the upcoming Australian federal election, scheduled for May 3rd. The election outcome remains uncertain, with polls suggesting a tight race. This uncertainty has the potential to create volatility in Australian markets, as investors await clarity on the future direction of the country's economic and fiscal policies. On the economic front, mixed signals are adding to investor anxiety. While some economic indicators, such as consumer spending, remain relatively healthy, others, like manufacturing activity and business investment, have shown signs of softness. This mixed bag of data has made it difficult for investors to gauge the strength of the underlying economy, contributing to the current market uncertainty.